All right. My name is Chris Campbell. I'm a practicing CPA and I work with small and mid-sized businesses to help them pay the least amount of taxes possible while keeping them out of jail. So today, for those of you who are involved in partnerships or S corporations, specifically if you are, obviously if you're in a partnership, it involves more than one person, but if you're an S corporation and it's more than one shareholder, so you have different partners, so to speak, but you're an S corporation and you receive your K-1s. I had a client who received a K-1 the other day. They're part of an S corporation and they received the K-1 and something just didn't quite look right. So the overall moral of the story here is just to check your K-1s and then just make sure it jives with what actually occurred in the organization with you as far as your dealings with the organization. So to go back to the story, my client had received this K-1 and it just didn't really add up as far as what transpired between them and the company and the K-1 that they received. So just to rehash the way it works when you receive a K-1, that's essentially what you use to report the income from the company on your personal taxes, right? Because with partnerships and S corporations, the companies themselves don't pay the taxes on any net income that they make. The owners, shareholders, or the partners do on their personal tax return. So the K-1 essentially reports and indicates to you what you need to report on your personal tax return. Where there can be issues is that when you have to report this income on your return, but there can be instances where you're reporting the income, but you actually didn't receive the money, but yet you have to pay income taxes, right? So this was a situation that my client found himself in. So they received this K-1 and K-1 indicated that they needed to report a good amount of money on their taxes, say it was roughly six figures on their taxes and additional income. But from talking with the client, and I'm just letting the client know what they have to report. And the client indicates, look, I never received any sort of that kind of money from the company. And now I have to pay taxes on these six figures. And I got nowhere near that kind of money to be able to pay the taxes. And now you're in a situation where it's like, well, look, I'm not looking to pay taxes on money I never received. So there could be two different scenarios that come with that, where one is just the K-1s can just be flat out wrong. And from looking at this was more of a situation where it was actually wrong, mainly because a K-1 will also tell you not only what your share of the income that you need to report, it also breaks down what was distributed to. So, one can clearly look and see, okay, telling me that I had to report X amount of income, but did you get enough, what they call distributions, to cover those taxes? So the distributions are essentially distribution of the profits. Those are sent out to the owners, the partners. And normally that's what's used to pay the taxes. In the case of my client, they had indicated that they had received these distributions to pay off these taxes. And they went back to their records. The client indicated that they never received any such thing. In this instance, the K-1 was just wrong. So they had to go back to the drawing board and draw it up. But a very important point here is that if you're involved in closely held partnerships or K-1s, just make sure that you review them, or whoever your tax advisor is, review them, especially when it's indicating that you're making a sizable amount of income, just to make sure that it jives with what you remember transpiring throughout the years. This was an instance where it was wrong and we had to send it back to the advisors of this particular corporation and they had to revise the books. But had we just went and blindly done it and not said anything, the client would have had to owe many thousands of dollars unrightfully, right? When they weren't really subject to that, and they would have had to come out of pocket for a good amount of those taxes. So that's a key point, to just check your K-1s. If you're not sure about it, just have the tax advisor just glance at your K-1s. All right. The other, and this one is probably more common, where the profits are there, but the distributions aren't made to cover the taxes. So as I mentioned before, because the company itself doesn't pay the taxes and it reports everyone's share of the income on their personal return, there could be instances where you report the profits to the partners or the shareholders, but those profits are still within the company. So as a result, the partners or the shareholders don't have the money on hand to pay for the profits because they're still sitting in the company. For example, if the company had a profit of say $100,000 and there's 4 partners, each partner has to report $25K on their personal tax return. But now let's say that 100,000 was still sitting in the company, right? Because you want to invest that net income into the company. You want to grow the company, but each partner still has to pay taxes on 25K. So how do you resolve that? What the partnership or the corporation needs to do is make a distribution specifically for taxes. So it doesn't necessarily have to distribute the whole, this case, 100K, but it needs to distribute enough so that each partner can pay their share of the taxes on that 100K. So for example, let's just say that for ease sake, let's say that all of the partners are in the 30% tax bracket, right? In that instance, everybody has to pay taxes on their 25,000. They got to pay 30%. So what the company should do is then set aside 30% of that net income to distribute to the partners that pay the taxes, right? So at 30%, that's 30,000 out of 100,000. And you distribute that, assuming that the partnership is even, split that 30,000 4 ways. What does that come out to, say 7,500 each? And then each partner would then get 7,500, and then they would now have sufficient funds to pay the taxes on their share of the 100,000 because they each have to report 25,000. Everybody pays 7,500 on that 25. So I've seen that more often where the partnerships don't realize that they need to make the distribution so that all the partners or shareholders can cover their tax bill. So those are 2 things to keep in mind when you're operating a partnership or a corporation, S Corp specifically. All right. Hopefully this was helpful. If you have any more questions about this topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. Well, that's all for now. I'll talk to you next.